Have you ever felt like the numbers on your screen are just a digital curtain, pulled over a reality so massive it would cause a panic if the average person truly understood it? I am not talking about a conspiracy theory. I am talking about the mechanical data that the most well-funded and sophisticated traders on this planet have been quietly acting on for 18 straight months. If you are making decisions based solely on the flickering red and green lines on your phone, you are missing the most significant market shift since the 1970s. While the paper price tells the world that silver is just another volatile commodity, billions of dollars worth of physical metal are being loaded into trucks and driven away from the vaults of Manhattan. This isn't a market correction, it's a systemic drain. Today, we are going behind that digital curtain to uncover who is actually buying, why the vaults are emptying, and why the US dollar is facing a countdown that even the Treasury can no longer ignore. Stick around, because the specific signals we are analyzing today will reframe everything you think you know about wealth. The center of this storm is the COMEX exchange, the global hub where silver is supposedly priced. But there is a glitch in the system that the mainstream media is ignoring. Since October 2025, total silver inventory at the COMEX has plummeted by over 31%. But the real danger lies in the registered pool, the actual metal available to back the futures contracts you trade. The coverage ratio, which measures how many paper claims exist for every ounce of physical metal, has been sitting below the 15% stress threshold for 6 consecutive months. Right now, it stands at a staggering 13.4%. To put that in perspective, imagine a bank that only keeps 13 cents of real cash for every dollar it has promised to pay its depositors. If even a fraction of those paper holders demanded their physical metal tomorrow, the exchange would face a total collapse. The question nobody is asking on television is, who is standing for all this delivery, and why are they taking the metal home instead of rolling their contracts forward? The answer lies with a silent giant that has fundamentally changed its behavior. In March 2026, data confirmed by Chinese customs and reported by Bloomberg showed that China imported 836 tons of silver in a single month. That is a 78% increase from the previous month and nearly triple the 10-year seasonal average. Until 2025, China was a net exporter of silver, shipping thousands of tons out of the country. Now, they have flipped to become the world's largest importer, reclassifying silver as a strategic material and restricting exports to only a few government-authorized firms. Even more telling is the China premium. While the paper price on your screen suggests silver is worth one amount, buyers in China are paying 12% to 17% more just to get their hands on physical metal. When the world's largest consumer and second largest producer is paying a massive premium above the official price, it tells you that the official price is a fiction. They aren't speculating. They are accumulating for a world where paper contracts are worthless. You might wonder, if demand is this extreme, why is the price on your screen falling? This is where the technical manipulation of the paper flush comes into play. Between December and January, margin requirements for silver futures were hiked by approximately 300%. For a retail trader, the cost to hold a single contract jumped from $15,000 to over $54,000 in just 6 weeks. This move was designed to crush the small player. If you couldn't fund the margin call, you were forced to sell. This wave of forced liquidation drove the paper price lower at the exact moment the big buyers wanted to accumulate. While the retail investor was panicking and watching their digital portfolio shrink, the sovereign wealth funds were saying thank you and taking delivery of record amounts of physical silver at the artificial discount created by the margin hikes. They are skating to where the puck is going, while the public is staring at where the puck was. This market tension is happening against the backdrop of a decaying US dollar system. In fiscal year 2024, the United States reached a milestone that historians call the point of no return. For the first time ever, the country spent more on interest payments for its national debt, $1.13 trillion, than it did on its entire defense budget. This is Ferguson's law, the principle that any great power that spends more on debt service than on its own protection is a power in terminal decline. The Congressional Budget Office projects that by 2031, every single cent of U.S. tax revenue will be consumed by mandatory entitlements and interest payments, leaving $0 for education, infrastructure, or defense without more borrowing. There is no manufacturing revolution coming to save the day, and a formal default would detonate the global economy. That leaves only one path: currency debasement. They must print the dollar into oblivion to pay back the debt with cheaper money. This is exactly why former Treasury Secretary Hank Paulson has publicly called for an emergency contingency plan for a collapse in Treasury demand. This isn't a gold bug on the internet speaking. This is the former head of the US Treasury admitting that the world may stop buying American debt. When the demand for treasuries collapses, institutional capital has nowhere to hide except in assets with no counterparty risk, assets that cannot be frozen, sanctioned, or printed out of thin air. This is why the largest central banks in Europe have spent the last year repatriating their gold and silver from the Federal Reserve. They no longer trust the custodian. They are taking their metal home because the convenience of a digital ledger is no longer worth the risk of a counterparty failure. The institutional smart money is already repositioning. Bank of America and Morgan Stanley have publicly stated that the traditional 60/40 investment model is dead. They are now recommending a 20% to 25% allocation to precious metals. Even the bond king, Jeffrey Gundlach, has admitted that a quarter of a portfolio in gold and silver is not an overweight position in this environment. These are the people who manage trillions of dollars, and they are dropping these signals on the record while the retail public is being distracted by the daily noise of the paper markets. The irony is that the very mechanisms used to suppress the price, the margin hikes, and the ETF rebalancing have provided the perfect entry point for those who understand the physical reality. To navigate this, I am watching 4 specific signals. First, the COMEX coverage ratio. If the registered pool continues to drain while open interest stays high, we are heading toward a force majeure event where the exchange simply stops fulfilling deliveries. Second, the China import premium. As long as China is paying significantly more than the Western paper price, the physical shortage is getting worse. Third, the 10-year Treasury yield. If yields rise alongside a falling stock market, it means capital is fleeing the entire system and heading for hard assets. Finally, the gold-silver ratio. It is currently at historic extremes, and every time it reaches this level, silver eventually outperforms gold in a violent upward compression. Wayne Gretzky once said the secret to his success was skating to where the puck is going, not where it has been. The paper price you see on your screen is where the puck is right now. The 31% vault drain, the 836-ton China import record, the 13.4% coverage ratio, and the $1.1 trillion interest payment crisis. That is where the puck is going. Every person holding physical silver or allocated metal instruments is positioned exactly where the most well-informed money in the world has been accumulating for the last 18 months. The paper price is the distraction. The inventory drain is the signal. All the data I have shared today is publicly available through the CBO, Bloomberg, and the CME Group. Do not take my word for it, verify the numbers yourself. This is not financial advice, but a clinical look at the structural cracks in a system that is running out of time. If this data-driven framework gave you a new way to read the market, tell me in the comments which number surprised you the most. Stay vigilant, because in a world of paper lies, the only truth is the metal you can touch. I'm John, and I'll see you in the next update.